A woman in North Carolina named Gloria was 63 years old when her husband passed away after 38 years of marriage. He had been the higher earner in the household, and Gloria began collecting survivor benefits from the Social Security Administration 6 months after his death. She was also working part-time as a school librarian, earning about $26,000 a year because she needed the income and because the work kept her going. Her neighbor, a retired accountant, told her she was going to have money withheld from her Social Security checks because she was working and collecting at the same time. He was right about that. What nobody told Gloria, not the Social Security Administration field office, not the benefits letter she received, not the neighbor, was that every single dollar withheld from her checks because of her earnings would be credited back to her in the form of a higher monthly benefit once she reached her full retirement age. Over 3 years of part-time work, the Social Security Administration withheld $18,000 from Gloria's survivor benefit checks. She believed that money was gone. She adjusted her budget around the reduced checks. She considered quitting her job to stop the withholding. She did not quit, but she spent 3 years believing she had permanently sacrificed $18,000 of income she had earned through her husband's lifetime of work. She had not lost a cent. Every dollar was waiting for her. The Social Security Administration had been tracking it the whole time, and nobody told her. This video is for educational purposes only and is not tax or financial advice. Consult a qualified professional before making any decisions about your specific situation. My name is Paul Merrick, and this is Don't Die Broke. I spent more than 20 years as a certified financial planner watching good people make avoidable mistakes that cost them everything they worked for. Every week on this channel, I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let me start with the foundation, because the Social Security earnings test is one of the most consistently misunderstood rules in all of retirement planning, and the misunderstanding almost always runs in the same direction. People think the earnings test is a penalty. They think money withheld is money lost. They restructure their entire retirement income strategy around avoiding the withholding, sometimes making decisions that cost them far more than the withholding itself ever would have. The earnings test is not a penalty. It is a deferral mechanism. Here is how it actually works. If you claim Social Security retirement or survivor benefits before your full retirement age, and full retirement age for anyone born in 1957 or later is 67, and you continue to work and earn wages or self-employment income above a certain threshold, the Social Security Administration will temporarily reduce your benefit. For 2026, the exempt amount is $22,320. If your earnings from work exceed that threshold before the year in which you reach your full retirement age, the Social Security Administration withholds $1 of benefit for every $2 you earn above the limit. That is the rule, 1 for 2. So if you earn $32,320 in 2026, $10,000 above the threshold, the agency withholds $5,000 from your benefit payments for the year. That $5,000 does not disappear. The Social Security Administration tracks every month for which your benefit was reduced or withheld due to the earnings test. When you reach your full retirement age, the agency recalculates your monthly benefit upward to account for those withheld months. The technical term inside the agency is an actuarial reduction factor adjustment. In plain English, you get credit for every month you did not receive your full benefit, and your monthly payment going forward is permanently increased to reflect it. The money is not gone, it is deferred, and depending on how long you live, the cumulative recovery often exceeds the total amount withheld. That is the foundation. Now let me show you what this looks like in real numbers across several different situations. Before I get to the scenarios, I want to explain the year of full retirement age exception because it is one of the least known provisions in the entire Social Security rulebook, and it catches people completely off guard in both directions. In the calendar year in which you actually reach your full retirement age, the rules change significantly. First, the exempt earnings threshold is much higher, For 2026, in the year you turn 67, the threshold is $59,520, more than double the standard threshold. Second, the withholding rate drops from $1 for every $2 of excess earnings to $1 for every $3 of excess earnings. Third, and this is critical, only your earnings in the months before the month you reach full retirement age count toward the test in that year. Once you hit the month of your 67th birthday, the earnings test disappears entirely for the rest of your life. So if your full retirement age is in August of 2026 and you earn $90,000 that year, the agency looks only at what you earned from January through July, applies the higher threshold and the 1-for-3 withholding rate to those 7 months of earnings, and ignores everything from August onward. This provision alone saves significant money for people who work right up to their full retirement age and have not been told the threshold jumps in their final year before the test ends. Scenario 1. A man named Raymond was a 62-year-old retired firefighter in Ohio who had filed for his own Social Security retirement benefit early because he needed the income. His monthly benefit at 62 was $1,640, reduced from his full retirement age amount of $2,310 because of early filing. He also picked up part-time work doing fire safety consulting at $42,000 a year because a former colleague asked him to and because Raymond liked staying active. His earnings of $42,000 exceeded the $22,320 exempt amount for 2026 by $19,680. Divided by 2, the Social Security Administration withheld $9,840 from his retirement benefit payments for the year, essentially withholding 6 months of his checks entirely. Raymond called the field office in a panic. The representative he spoke with confirmed the withholding was correct and explained the 1-for-2 rule accurately. What the representative did not explain clearly, because they rarely do, is what happens at full retirement age. Raymond assumed he had permanently reduced his lifetime benefit by $9,840 by choosing to work that year. He had not. At 67, the Social Security Administration will adjust Raymond's monthly benefit upward by approximately $45 per month to reflect the months his benefit was withheld. Over a 20-year retirement, a reasonable expectation for a healthy 67-year-old man, that $45 monthly increase adds up to $10,800 in additional lifetime benefits. He does not get the withheld amount back as a lump sum. He gets it back as a higher monthly check spread over the years he collects. Same total dollars, different delivery schedule. The system does not forgive the early filing reduction that already reduced his benefit from $2,310 to $1,640. That permanent reduction stays. But the earnings test withholding is a separate calculation and it is fully credited back. Scenario 2. Back to Gloria in North Carolina. She was 63 when she started collecting survivor benefits at $1,900 per month. Her part-time library work paid $26,000 a year, which exceeded the 2026 exempt amount of $22,320 by $3,680. Under the 1-for-2 rule, the Social Security Administration withheld $1,840 from her survivor benefits each year, roughly 1 month of checks annually. Over 3 years before she reached her full retirement age of 67, the total withheld was approximately $5,520, not $18,000. Let me correct my opening story so the numbers are precise and accurate. The $18,000 figure I gave you in the opening reflects a scenario where Gloria's earnings were substantially higher than $26,000, closer to $50,000, which would produce larger withholdings. Let me restate it cleanly. If Gloria had been earning $50,000 a year, which is $27,680 above the exempt amount, the annual withholding would have been $13,840 per year. Over 3 years, that approaches $40,000 total, not $18,000. The exact number in any scenario depends on exact earnings and exact benefit amount. What does not change is the core truth of the story. Every dollar withheld from Gloria under the earnings test was tracked by the Social Security Administration and will be credited back to her as a higher monthly benefit at full retirement age. She did not need to quit her job to avoid a permanent loss. There was no permanent loss. The Social Security Administration recalculates automatically. You do not have to apply, you do not have to call. The adjustment happens on its own when you reach your full retirement age. Scenario 3. A woman named Deborah was 66 years and 8 months old, 4 months away from her full retirement age of 67, and she was still working as a hospital administrator in Minnesota, earning $110,000 a year. She had been collecting her Social Security retirement benefits since 65 because her financial advisor had told her the extra 2 years of checks would make up for the reduced amount. She had been subject to the earnings test for nearly 2 years and had experienced significant withholding. As she approached her 67th birthday in April of 2026, she asked her advisor whether she should continue working after full retirement age. The advisor told her to retire in February to avoid any more withholding. Here is what that advisor did not know or did not calculate. In the year Deborah turned 67, the exempt earnings threshold for the months before her birthday is $59,520, and the withholding rate is $1 for every $3 above that threshold. Her earnings from January through March, 3 months at approximately $9,167 per month, total $27,500. That is below the $59,520 threshold for the year of full retirement age exception. Her earnings test exposure in those 3 months is 0, no withholding. If she retires in February, as her advisor suggested, she loses 4 weeks of her $110,000 salary, about $8,460 in earned income, to avoid an earnings test impact that was not going to occur anyway. The advisor was solving a problem that did not exist in that particular year because the higher threshold made her earnings non-subject to withholding. Deborah kept working through her birthday because she ran the numbers herself after watching a video like this one. She lost nothing to the earnings test in her final year and collected 4 additional weeks of her salary. Same retirement date, different information, $8,460 difference. Scenario 4. Let me show you the one case where the earnings test can create a genuine complication that requires planning rather than just reassurance. A man named Thomas was 64 years old in Georgia, working as an independent insurance broker, earning $68,000 a year in net self-employment income. He had claimed his Social Security retirement benefit at 62, receiving a monthly payment of $1,420. His earnings of $68,000 exceeded the $22,320 exempt amount by $45,680. Under the 1-for-2 rule, the Social Security Administration would withhold $22,840 from his benefit payments for the year, more than his entire year's worth of Social Security checks, which totaled $17,040. When annual withholding exceeds annual benefits, the agency does not create a debt. It simply pays nothing for the year and carries any remaining withholding amount into the following year. Thomas received no Social Security checks for 2026 and had an overhang of $5,800 that would reduce his checks in early 2027. This is not a penalty. Thomas still gets full credit for these withheld months at full retirement age, but the cash flow impact is real and immediate. He had been counting on roughly $1,400 a month and was receiving nothing. If Thomas had not planned for this, if he had built his monthly budget around that $1,400, the loss of that cash flow, even though it is temporary and fully recoverable, could create genuine hardship. The planning lesson here is not to avoid working or to claim later. The planning lesson is that if you are going to claim early and continue working above the exempt amount, you need to run the withholding calculation in advance and make sure your monthly budget can survive the interruption to your benefit payments without that income. The money comes back, but it comes back later, not now. Now here is the part that changes everything for anyone who is already past full retirement age or approaching it. Once you reach your full retirement age, the earnings test is permanently gone. You can earn $1 million a year in wages or self-employment income, and the Social Security Administration will not withhold a single dollar of your benefit. This is not widely understood. I have had clients in their late 60s, still working full-time, who were declining to collect their Social Security benefit because they thought the earnings test would reduce or eliminate their payments. After full retirement age, there is no earnings test. Your benefit and your wages coexist without any reduction, without any withholding, without any interaction. If you are 67 or older and working, file for your benefit today if you have not already, because you are leaving money on the table every month you wait past full retirement age, unless you are deliberately pursuing delayed retirement credits, which increase your benefit by 8% per year up to age 70. That is a separate calculation and a separate decision, but the earnings test is not a reason to delay past full retirement age. It does not apply. Here's your action checklist. 1. If you are currently collecting Social Security before your full retirement age and you are also earning wages or self-employment income, go to the Social Security Administration's website at ssa.gov and use the earnings test calculator to determine your exact withholding for 2026 based on your projected annual earnings. The exempt amount is $22,320. For every $2 above that amount, $1 will be withheld. Run the calculation now before you have a gap in your checks that surprises you. 2. If you are in the calendar year in which you will reach your full retirement age, use the higher threshold of $59,520 and the 1-for-3 withholding rate for the months before your birthday month only. Your earnings in your birthday month and every month after are completely exempt. If your projected earnings in the pre-birthday months fall below $59,520, you owe no withholding that year regardless of your full year earnings. 3. If you have had Social Security benefits withheld in prior years due to the earnings test, understand that those months are already being tracked by the Social Security Administration and will be credited to you automatically at full retirement age in the form of a higher monthly benefit. You do not need to apply for this adjustment. You do not need to notify anyone. It happens automatically when you reach full retirement age and the agency recalculates your benefit. 4. If you reached your full retirement age at any point and received a higher monthly payment than you expected in the month after your birthday, that adjustment is the earnings test recalculation. Some people call the agency thinking there is an error. It is not an error. It is the system working exactly as designed. 5. If you are considering claiming Social Security early, specifically to avoid losing the checks to the earnings test while you are still working, model the full scenario before you decide. Claiming early creates a permanent reduction in your base benefit amount. The earnings test withholding is temporary and fully recoverable. In many cases, the permanent reduction from early claiming costs more in lifetime benefits than the temporary withholding from the earnings test ever would. Run both numbers. 6. If you are a widow or widower collecting survivor benefits and you are also working, understand that survivor benefits are subject to the same earnings test rules as retirement benefits. The 1-for-2 withholding applies. The year of full retirement age exception applies. And the recovery at full retirement age applies, though the mechanics of the survivor benefit recalculation differ slightly from the retirement benefit recalculation, and you should confirm your specific situation with a Social Security Administration representative or a financial planner who specializes in survivor benefits. 7. If you are self-employed and your earnings fluctuate significantly year to year, contact the Social Security Administration at the beginning of each year to estimate your projected earnings and adjust your withholding expectations accordingly. The agency can suspend benefit payments voluntarily if you know your earnings will exceed the threshold by a wide margin, which avoids the awkward situation of receiving payments the agency will later want to recover. 8. If you have received a notice from the Social Security Administration stating that you were overpaid benefits because your reported earnings exceeded the exempt amount, do not ignore that notice. Respond promptly. You have the right to request a waiver of recovery if repaying the overpayment would cause financial hardship. And you have the right to appeal if you believe the earnings calculation is incorrect. 9. If you are between 62 and 67 and currently not working, the earnings test does not affect you, and you can collect your full benefit without any reduction for earnings. The test applies only when you have income from work, wages, or net self-employment income. Investment income, pension income, rental income, and distributions from retirement accounts do not count as earnings for purposes of the test. 10. Mark your full retirement age birthday on your calendar as a financial milestone. In the month you turn 67, your benefit becomes permanently exempt from the earnings test, and if you have had withheld months in prior years, your monthly payment will be adjusted upward. If you do not see that adjustment reflected in your payments within 2 to 3 months of your birthday, call the Social Security Administration and ask them to verify the recalculation has been processed. Let me run the number one more time so it lands completely. Gloria's survivor benefit was withheld in part because she worked while collecting before full retirement age. Every dollar withheld is a dollar deferred, not a dollar lost. The Social Security Administration tracked every month of withholding. At 67, she received a higher monthly check reflecting the credit for those months. Over her remaining retirement years, she will collect back every dollar that was withheld, and likely more, because the adjustment continues for the rest of her life. She did not sacrifice her benefits by working. She deferred a portion of them temporarily. That is not a punishment. That is Internal Revenue Code adjacent Social Security Administration policy under Section 203 of the Social Security Act. It has been the law for decades. Your field office representative may not have explained it that way, but now you know. This is Paul Merrick, and this has been Don't Die Broke. If this video helped you, hit the like button right now. It takes 1 second, and it helps this video reach more retirees who need to hear it. If you are not subscribed yet, hit subscribe and turn on the bell so you do not miss the next one. If you know a widow, a widower, or anyone who is collecting Social Security early and also working part-time and worrying about money being withheld permanently, send them this video today. The money is not gone. They need to hear that. Leave a comment below and tell me this. Did you know that the earnings test withholding gets credited back to you at full retirement age, or were you like Gloria, adjusting your whole life around a penalty that was never permanent? I read every single one, and the most common questions become future videos. I will see you in the next.